Yeah? Okay, so here is what we did so far. All we did so far is introduction to financial economics. And financial economics is the subject that studies the financial system. Okay. Financial economics goes into two separate fields. One very narrow field is the field of monetary economics. And monetary economics is the subject of the monetary system. Monetary system. And monetary system consists of the, over there, yeah, central bank, and commercial banks. Okay, so this is the subject called money and banking, and that's what you're supposed to study there. The second area or field of monetary economics is the general field of the financial system. And the financial system has, again, repeating from the first lecture, three elements. Financial markets, financial institutions, and the third one will be financial instruments. So, what we did so far was for financial economics would be chapters 1 to 4, only introduction, only overview, okay? Now, we move to the financial system, and for financial markets, we'll be doing chapters 5, 6, 7, 8, 9, 10. 5, 6, 7, 8, 9, and 10. Okay? So these are the financial markets, respectively. Money market, next one is the bond market, mortgage market, stock market, two more, forex, as in foreign exchange market, and what's the last one? Derivatives market, or markets, because there are many. Okay, so this is what we're going to be doing over the next, I don't know, 2 months, month and a half, whatever, 6 weeks, whatever it takes. All right, and now we're moving to this area of financial markets. Now we're moving to Chapter 5, Money Markets. Now, going back to Chapter 4, make it Chapter 5. Money markets. Are financial markets for short-term instruments. A different way of saying is for money market instruments. Or we can say money market is a financial market where money market instruments are traded. Okay. They have, let me see and find out over here, 3 primary characteristics of money markets. Number 1 is large denominations. Denomination is the amount of money related to one particular instrument. So a bond may have a denomination of $1,000. It may have a denomination of $1 million. Let me see, I'm pulling out. So dollars will have a denomination of a $1, that's the face value, or it may have a $50 denomination. And of course, you may have a 5,000 denomination of your currency, or 10,000, or 20,000, maybe there's even 50,000, right? So, denomination is the size, dollar or currency size related to particular instrument. So money market instruments are generally have large denominations. Some may be 1 million, some may be 10 million, some may be 100,000, and of course some will just have $1,000. So that's number 1. Number 2, low risk. Low risk. These instruments are considered to be relatively low risk. Now, it's very important to understand that doesn't mean that the risk is low. Here, when we say low risk, we mean specifically low default risk. Default risk. Default risk is the risk that the obligation will not be paid in time and in full. Now, all of them still have currency risk. If the currency crashes, you still get the risk of currency. So you still get a currency risk. If there is a price inflation, you still have inflation risk. So other risks are present, but at least the risk of default is low. And let's see what's the third characteristic. Well, the third characteristic is short maturity. Short maturity. Sometimes 1 week, more commonly 1 month, 3 months, sometimes 6 months. Usually less than, we define it as less than 1 year, but in practice it's less than 270 days, less than 9 months. Because if it's more than 9 months, now there are regulations and other things happen. So these are the 3 money market, we gotta call them characteristics. Okay? And now we get to discuss the, let's see where and how. That will be in the textbook table 5.2, money market instruments. So, instruments. We say money market financial instruments, okay? And we cover exactly 6. Now, you could have 10, you could have 20, you could have 100. You know, a financial instrument is created through financial innovation. You can have as many instruments as you can create. So these are the 6 primary. They're like 99% of the market, okay? You may have all sorts of others, but these are the big ones. These are the main ones. These are the ones that determine the overall functioning of the money markets. So, first one. Treasury bills, sometimes the treasury is shortened for T, standing for T-bills. Number 2 is Fed funds. Number 3 will be repos. Number 4 will be commercial paper. Number 5 will be negotiable CDs. And number 6 is bankers' acceptances. Okay, so these are the primary instruments. So, what we try to do is a number of things. First is essentially what this chapter is about is go slowly and describe these. So, the description includes basic definition, may include size, may include some characteristics, will include the working of the market, how the market works, and finally, who? We call it market participants. Market participants will be financial institutions, maybe the central bank, individuals, as in households, and maybe businesses or corporations. So we'll go slowly, step by step, to cover these. Okay, let's see what else I have. Well, that's it. Number one. Well, maybe I can do on this side now. Okay, let's do this side. Number 1, Treasury bills. are short-term obligations of the US government. Well, in this particular case, Treasury bills were short-term obligations of the central government. Because France will have, and Germany will have, and Canada will have, and every country will issue its own Treasury bills. So, issued will be by the central government. For every instrument, the most important characteristic to recognize and understand is the risk. These are said to be, but it's not at all true, and I've just already explained. They're said to be risk-free, and they're considered to be risk-free. But just because it's said to be risk-free and considered to be doesn't mean. All it means is that they are default-free. That's basically true because it doesn't matter how much money the government owes, it can always print the money and pay back. Okay? It has control of its own printing press. So the government will not default, okay? But they're still subject to, as I said, actually many risks. They're still subject to inflation risk. So you buy the bond in the T-bill for 6 months. After 6 months, prices went up. You lost purchasing power. Okay? Exchange rate risk. You bought it, but the currency you bought it in, whether it's US dollars or Japanese yen or whatever the currency in euro, the currency fell. So when you exchange the currency to some other currency, you still have exchange rate risk. And you can go through some of the risks that we did before. They are subject to some sort of interest rate risk. Again, it's very important to understand that everybody keeps saying that they're risk-free and this is the risk-free rate, but it's not. It's only default-free. All the other risks are essentially present. The next main characteristic is that the central bank uses treasury bills to conduct monetary policy. It will buy them, drive the price up and interest rates down, or it will sell them and drive the price down. So one of the tools of monetary policy by the central bank is through the sale or purchases of T-bills, okay? We call these open market operations. Again, open market operations are sales and purchases of treasury bills by the central bank for monetary policy purposes in order to affect the money supply or interest rates. Maturity, of course, you got lots of maturities. But the big ones we're told are 13 weeks and 26. In other words, 3 months and 6 months are the most common maturities. Let's see. This applies. This is now beginning a general concept. It applies to these, but applies to the sale of any security. It's a mechanism to sell security. And any security could be done when it's sold with a bid. People will bid. They will ask or offer how much they want. So, bids are competitive bid. And non-competitive bid. Some securities will use only competitive bids. Other securities will use non-competitive bids. And some will use both competitive and non-competitive. Now let's see what's the difference. A competitive bid will specify the desired quantity and price. In other words, the government says, we are selling securities $1 billion and is asking how much you want. And you say, I want 1 billion at that price. You want $500,000 at that price. You want 20 million at that price. And you want 50 million at that price. So a competitive bid will provide both the quantity, the size, how much you want to buy, and the price you want to pay. And then all the bids are ordered by price. You order the highest, will give you first. You order the second highest price, will give you next. You offer the very low price, you get nothing. You order a high price. So what happens is, again, a little picture. Somebody offered very high price, they will get. The next person will offer the next price. They will get whatever quantity they want. The third person will offer a lower price, very high quantity. Then a few people offering, okay? So it keeps going. And this here represents the quantity. Large quantity, very large quantity, very small quantity. Well, the government says we are offering that much for sale. So, everybody, this is the price. Everybody who offered this price or above will get as much as they wanted. Everybody who offered below gets, so here you get pretty much almost. That's a way to think about it. Everything you ordered, and below this price, you basically get nothing. So, you offer a high enough price, you get it. You offer a low price, you don't get it, okay? And this is competitive bid. The next thing to understand is that when you offer the high price, doesn't mean you're going to pay the price you offered. Everybody who gets the bid will pay the same price. So you may have offered the high price, but you're going to pay the price like everybody else. So whoever pays the lowest price, everyone will pay the same lowest price. So, for example, I'm just making the example for you to understand that nothing to do with the real numbers. Is you're offering 60 cents, 70 cents, 80 cents, 90 cents, 100, 110, 120, 130. This is 150, 160, 170, 180. And if you offer 170, you will get your quantity at the price of 140. And that's the way it works, okay? You're not going to pay the high price that you actually offer. But if you offer the high price, it means you really want to get it. But you don't know what the price. If you offer a high price, one thing's for sure, you will never pay above what you offer. You're likely to pay below, but you don't know how much. Because it depends on who else wants to get it. Well, that's competitive bid. Now, going back to non-competitive bid. In a non-competitive bid, you say how much you want. You say the quantity. You want 50 million and you want 1 million. Non-competitive bid is always guaranteed to be always fulfilled at the competitive price. So, I'm just saying I want 1 million. Whatever the market price turns out to be. If the market price is 140, you will pay 140. If the market price is 90, you'll pay 90. But if the market price is 180, you will have to pay 180. Okay? So, in a non-competitive bid, you say you want 1 million, whatever the market price turns out to be. You'll have to buy at that price. And that's the way it works. So, non-competitive bids get filled out first at whatever the market price is, and then you fill out everybody else above, who bid above the market price, they'll get it at this. In other words, whenever there is a bid, everybody will always pay, competitive or non-competitive, bid above, will always pay the competitive price. We will pay exactly the same price. These guys will always get the full quantity or proportion full quantity. These guys above, bidding above, will also get their full quantity, and these guys will get nothing. The only difference will be in those guys here, they may be getting a proportionate. In other words, you bid right at the price, but too many people bid at the same price, so they'll just give you half and half. And that's how the competitive and respectively non-competitive bids work. So for this particular market, both are used at the same time, and you choose to make a competitive or non-competitive bid. Okay, let's see what else. Next one. For any country, for any financial system, T-bills will have dealers. And we just call these government securities dealers. And they are, if we look, let me see, they are in the United States 24. To be a government dealer, and we call these primary dealers. Are the only dealers that have the right to purchase from the government. Everybody else can't. It's a privilege. You must be rich, you must be connected, you must be part of the establishment, and this is a very profitable business. It is a business for trillions of dollars of volumes that can generate tens or maybe hundreds, tens of billions of dollars of profit. And there are only 24 of you who could do that. You're a dealer, it means that you buy from the government and then sell, meaning resell at a profit to another bank, to a mutual fund, to a hedge fund, possibly but not very likely to individuals. So you buy and then you sell it. And the difference between the buy and the sell is called the spread. Spread. So, spread is the difference between a bid and an ask, the price that you offer to buy and sell. Or, spread is simply the difference between the price you actually buy and actually sell, okay? So, the spread is the return to the dealer, because it's a commercial activity, we also call it a profit, okay? So, these four are privileged. They got a phenomenally profitable monopoly, because they're 24, it's technically oligopoly, to profit from this government business. You must be very well connected to the business to have this particular privilege. Now, in a smaller countries like Bulgaria, we got only, let's say, 20 banks, and maybe the 10 best, most politically connected banks, politically connected to the government, will have this particular privilege. If you're a smaller bank or mutual fund or anybody else, you'll have to buy from them only, okay? So, these are the primary dealers. They're the only one who can buy from the government and then they resell to everybody else. And then we have what's called a secondary market. A secondary market, again, is a market where anyone can buy and sell existing securities. So, primary dealers are associated with the primary market. Primary dealers participate in the primary market where they buy the security from the government when the securities are issued. Then the primary dealers also participate by making a secondary market. Anytime you bought, you may be mutual fund, insurance company, anybody who has a government T-bill can sell it back to the primary dealers, or you can sell it to any other government security dealers. So the secondary market will include all the primary dealers and any other financial institutions. Could be investment banks, could be brokerages, could be commercial banks that will do this business for you. Secondary market could be even thought of as a commercial bank which buys 1 million a treasury bill, and then you want 1,000, they'll sell you 1,000. You want 2,000, they'll sell you 2,000. You want 5,000, they'll sell you 5. And then maybe after 2 weeks later or 2 months later, before it matures, you may sell it back to your own bank or to any other bank or to any other financial institution that makes a secondary market on it. This market is considered, both the primary and especially the second, is considered to be the most liquid financial market in the world, okay? It's highly liquid because it's considered or thought to be risk-free. And for now it has been default-free. Okay, primary, secondary. These securities are registered. Now, the alternative to registered is called bearer and bearer instrument. This is a registered instrument. Registered means that there is no physical certificate of the financial instrument. It is all in a ledger. Ledger is a list of all securities and their owners, or a different way, list of all owners of the securities, and is similar to a list like this. And it's kept in an electronic form in a government computerized system. Okay, so it's in a ledger form, it's registered, so at any point in time you can look up the register and see who the current owners are. And the register is changed by, this is now a system specific only to the United States, but other governments will use similar system of their own called FedWire. FedWire is the Federal Reserve's transfer system, transfer of title, transfer of ownership system. Basically, two banks, member of the Federal Reserve. The Federal Reserve will keep record, and when you sell the security, the Federal Reserve all will do is change the ownership from Bank A to Bank B. So the securities exist, and at any point in time, they'll indicate who was the old buyer and who's the new buyer. And the transaction will simply say old buyer, seller, and new buyer. Okay, old seller and new buyer. Okay, so it's also called, the ledger is simply called a book entry system. There is no paper. You can't show it. You can't have it. You can't touch it. You can't feel it. It's just a computer system, okay? So that's registered. There is, of course, because of that reason, no physical transfer of paper. There is no physical transfer of paper. Okay, there's no physical certificate. Okay, next one. These instruments sell at a discount. Now, bearer instrument is an instrument that is paid at maturity to the holder, meaning the person who bears the instrument to the issuer. So bearer instrument is essentially an instrument which is a certificate. Certificate is a piece of paper which identifies what is the face value, what is the amount due, right? The date, which is the maturity, and the issuer, in other words, who is responsible for the payments and where to present it for payment. So, if I give it to you, this means now that you are the bearer, okay? And if you're the bearer, you represent the owner, so you can have it. And the best, supposedly most prominent bearer instrument here in this country is the motorcycle, or ownership. whoever bears this particular instrument, okay, this is an instrument of ownership. It doesn't matter whose name it says, it's whoever bears it, whoever owns it, whoever carries it, represents the owner of that particular, in this case, is going to be vehicle. Okay, that's a bearer. Okay, now the most famous bearer instrument is the cash, the bank deposit. It belongs to those who has it in his own pocket or in his own wallet. It has no name on it. Whoever has it owns it, okay? And can use it for whatever purpose. So that's a bearer instrument. Other money market instruments are bearer instruments. Let's see what we got to finish and what else we got. Competitive, non-competitive, primary dealers, okay. Bearer registered, okay. It's sold at a discount. Discount means that you buy it at a price lower than the face value. It means there is no interest payment during the life, and at maturity, all you get is the face value. Your return is represented by the difference between the discount price that you paid and the face value. That's the return. Finally, here is now the good news, right? Yields. There are 2-3 different types of yields. The good news is we will not study here the yields and how to calculate the yields. So you'll be able to survive and pass this course without any calculation, without any math, and without any formula. Some people are smiling, right? Right? You can actually, this is the part that amazes everybody. The most amazing part is that you can actually learn and become really good financier with zero math and zero numbers. This is how the good guys work, you know. Only the bad guys do all the crunching, you know. The famous, glorious, let's say Warren Buffett, he doesn't do any of the financial math and all the other stuff. He doesn't need it. To be good in finance, you need common sense and understanding of how things work. You don't need the math crunching skills, okay? This is not necessary to be good in finance. You don't need to crunch math to understand that there is a giant real estate bubble in town, and when the bubble collapses, so will the banking system with it, and so will the economy with it, and so will the currency with it, okay? You don't need math to do that. And here, we don't need to do the math to calculate the yields. Let's see what else. The yield is simply called, without doing any math, called the discount yield. And you can see it in the textbook how it's done and how it's calculated. It's very simple, very easy, but you don't need to do that. The reason is that in this course, another requirement is that we study actually real world stuff, not mathematics. Real world is what is the global financial crisis, what is a bubble, what is a currency crisis, what is the Asian financial crisis. So instead of spending 3-4 weeks on mathematical calculations, we're going to spend 3, 4, 5 weeks on real world events and what's going on around the world in the last 10 or 20 years. Let's see what else I have to complete this section. Well, that's the section is completed. So number 1, T-bills is completed. And with this we finish the lecture. Camera.